What's up guys, welcome back to another video on the beginner series. This one, as you can tell by the title, is going to be on support and resistance or key levels or pivot points, whatever you want to call them. So first of all, what does it mean? Support and resistance, think of it as like a floor or a ceiling that price respects. Now what do I mean by that? So first, you can hop on any chart. This will work for any asset. NQ, S&P 500, QQQ, Apple, Amazon, Google, Bitcoin, Ethereum, whatever. Doesn't matter what it is. This is going to work on all assets if it's able to be displayed on a chart. So first of all, we'll hop on here. We are on NQ as you can see, but there are always going to be certain areas of price where you can clearly tell that there was a positive or a negative reaction once price moved up into that certain spot. This horizontal line, you'll see that here, for example, both times that we came down into this, we shot up pretty notably. Just like in the reverse direction, this holds true as well back here. So that same exact line that I just drew, right? Previously, it was a notable resistance where every time that price came up into it, we would sell off until eventually it flips and becomes a support. But you can clearly see every time that NQ moved into that spot, there's a notable reaction where either buyers or sellers stepped in and price reacted accordingly. So if buyers are stepping in and it is a key support now, obviously we are going to see price move up. And in the opposite direction, if sellers step in and they take over off of that key resistance, then we move down. So pretty straightforward. So next up is why should you care, right? And how can you use this and these levels to improve your trading journey and your skill set? I don't know why I said improve your journey like this. We're not going like on a destination wedding, but you get the point. Why should you care and how can you use this to make more money? That's what we're here to do. So you are looking for notable reactions in price. Now, if you are able to take an educated guess on how price is going to react once it moves into that spot, obviously that can be leveraged as an edge, right? Or it can give you a clue to what we're going to see in terms of movement once price reaches that spot. So for example, if you were fairly confident that every time price came down to test this level right here and it would bounce, obviously you'd be prepared to take a buy position or go long at that level. Same exact thing to the reverse. If you had a key resistance here and you were fairly confident that every time price moved into it, you would make money if you were to go short or you were to bet that it was going to go back down, then you can use that as one of your confluences and a part of your strategy. So that's why this matters. It can help you give a bigger picture or even a smaller picture idea of how things are going to react once prices reaches that point, whether it's to the upside or to the downside. Now, with all this being said, a lot of people will just blindly take a buy position or a sell position as soon as price hits a certain level. What they don't do is they don't wait for a couple things to set up to wait for an actual reaction once it reaches that point. Now, I did say just a second ago that you can use this as an edge or take an educated guess based off of what you think the price will do once it reaches that spot. However, you should never just blindly take a buy position here just because it came down, or in the other direction, you shouldn't just blindly short just because it reaches this spot. Now, you might be right on your educated guess a couple times, but this is not a feasible long-term strategy, at least in my opinion. So that is not what I'm going to suggest that you do. So we've already talked about candlesticks and the importance of waiting for candle closes. The reason for that will be later on in the series when we talk about liquidity sweeps. But for the sake of this video, just a quick explanation. Say that a new candle is starting to print and it's a green one, means it's bullish, means that price is moving to the upside. So before it has finally closed, whatever time frame it's on, doesn't matter if it's on the 1 minute chart, 5 minute chart, 15 minute chart, 1 hour, doesn't matter. This candle is still forming right now. So it has not closed yet. Okay. Whatever that time frame is that you're looking at, it is still in play and it's still not closed. So it's still moving up and down. A lot of people will almost always go short and bet that things will go back down. Now, like I said, you might be right a couple times. It might work for you, but in the long term, the best way to capitalize on moves like this is always to wait for a reaction as well as a candle close. So whichever time frame you trade off of, whether it's the 1 minute time frame or the 1 hour, doesn't matter. The principle is the same no matter what time frame you're on. So say for this example, this is on the 5 minute chart. So it closes back above this level. Now imagine if you had already gone short when we were right here. Okay. Now that you see this candle closed above your level, you're already losing money. You're already underwater. Now what you should always do is wait for a reaction of these candles. What that means is you shouldn't just wait for that first initial touch of the candle into that level. You should always wait for the time frame to close, that candle to close and fully form. That will give you the most accurate picture of what's going on and how price is likely going to react from there. So there are a couple different scenarios that could play out here. So first one is the one that I already drew out. Clearly, price closed above that level, which means that there are not enough sellers interested in pushing the price back down. There are more buyers present who want to see things go higher instead of sellers who want to see things go back down. Now here, the likelihood that maybe there's a small pullback or a small retracement back to that level to make sure that it's still valid and it is now acting as a new support. Or another scenario is that things just keep moving higher after that candle close and there's no pullback. There is also a possibility that this is a fake out to the upside and the next candle could open up like this. It could look like it wants to push, and then it just, obviously you get the liquidity sweep of doom. That will be covered in a later video, but I'm not saying that this is not a possibility. It absolutely is. However, where the most people get screwed and where the most people get faked out is in this scenario. So that I'm about to draw right here. So say I have this nice green candle that has not formed yet, that is not closed yet. Okay, it's still, it looks like it's pushing higher. It's jiggling around above that previous level. However, when it closes, it actually closes red and closes red like this, and it will leave a nasty wick above that level like this. So we talked about this on the candlestick video real quick. This is like one of the two candle patterns that I actually care about. This is called a hammer or an inverse hammer because it's upside down. So what this means is that there are a ton of buyers who got trapped above that level because they thought that price was going to move higher. So they all bought in along this wick. Their positions are all in this area. However, now price is already way back down here. This means that they're already down on their positions, which means that they're losing money. Nobody likes to do that. So the likelihood that they exit their positions and create additional selling pressure, that is more likely to cause a reversal or a pushback to the downside. Same exact thing to the opposite direction. Say that this is a red candle. Say that this horizontal line right here is a previous support. So in the past, that means is that more times than not, price would come down and immediately bounce off of it. So it's acting as a support. It's supporting price. It's pushing it back up, just like a support beam, whatever. It's pretty self-explanatory, but this is a previous support. Now we have this red candle here that is not closed yet. It looks like it's about to, but whatever, last second or last minute, whatever, it decides to close back up like so, leaving behind a long freaking wick to the downside, and the candle closes green. Doesn't necessarily have to close green. In this scenario, it can still be a green candle, but the most important part is the wick, and the candle close is above or below the level in this scenario or above the level in this scenario. Okay, that's the main part we're talking about here. So just like in the previous example where buyers were trapped, now in this case it's the reverse. Now sellers are trapped because they all shorted thinking that things are going to keep going down along this wick because they did not wait for the candle to close. Okay, I'm kind of realizing now that this is kind of turning into the liquidity sweep video, but that one I kind of go into more detail, and it's more fun. So whatever, it's the more the merrier. Okay, this is still the lesson on support and resistance and how you should wait for the reaction when you're trading based off of them. So the point still stands. So all these sellers are now trapped because they did not wait for the candle close above this key support. Now they're all screwed and they need to now buy their positions back, which creates additional buying pressure, which increases the chances that there's a reversal to the upside. Anyways, the moral of the story is to wait for the reaction, wait for the candle close, always wait for the candle close. I will never at least at the time of this recording, maybe, my trading style would change as time goes on. It probably will, but I will never just enter a position. I will never enter a long position or a buy position just because we are moving into a key support. I'll never just blindly do that. I will always wait for a candle close so that I don't get caught in a situation like this. Okay, and I suggest you do the same so that you don't get rinsed. But anyways, just like that, I will always wait for the candle close the opposite direction as well. Just because we are moving into a key previous resistance, I will not just blindly go short here. I'm always going to be waiting for the candle close and wait for the reaction to fully show itself instead of guessing that price is going to do what I think it will. So I'm not going to just blindly take a short position thinking that we're going to reverse just because we are moving into a previous resistance. Now with that being said, right, I still have like biases, and I still lean a certain way when price is moving into a certain area, especially depending on the time frame. So what I mean by that now is you have all of these different time frames on TradingView or whatever software or chart platform you're on. You'll have the 1 minute, well, all the way down to like the 1 tick or the 1 second, all the way up to the 1 year chart, right? So why I'm talking about this is because different supports and resistances will have a different amount of strength or a different amount of credibility to them. Say you have two levels right here. Say that the green one here is a 1 minute support. However, the red level is a 1 hour resistance. So say for the sake of this example that price is moving around these two levels. Now on one hand, right, if I were only looking at the 1 minute chart and now we're taking everything based off of that, I would think that we're going to move higher. Say price is doing one of these, right? It's hanging around here on top of this green level, and I see that as a previous support. I might think that it's going to push higher. However, the proper way to approach this is to always give more validity and give more power to the higher time frame level that is being shown by that higher time frame level. So there's more strength to it, which means that you need to pay more attention to it compared to a lower time frame level. Especially if I see a 1 minute support and a 1 hour resistance right on top of each other, basically, I'm always going to be paying more attention to the resistance and expecting things to push lower if we can't stay above it. So just keep that in mind when you are marking out your key levels or your support and resistance. You always need to pay more attention to the higher time frame level. Now for the last part, this might be the easiest part of the video. So actually marking out these key levels. So a lot of people like to complicate the act of drawing up and marking out these key levels, but it's really not hard. Okay. Obviously, you need to practice and get your own repetitions in, but the actual concept of it is very simple, so do not worry. Now, you can do this on every single time frame, whether you use the 1 minute or the 1 hour or the 1 day or the 1 year, does not matter. Right now, I'm on the 1 minute chart, but like I said, right, the process of actually marking these is the exact same no matter what time frame you're on. So first up, all a support and resistance is like I said, it's like a floor or a ceiling, or a peak and a valley, right? Whatever you want to call it, it's all the same stuff. All you're going to do is go on the chart, click on your horizontal line tool, your drawing tool. Now mark up any notable peaks and valleys where price either bounced or rejected off of. So here you see this wick, we moved up into there and then immediately sold back off. However, this previous support, right, we bounced off of this previously, is now we broke through it and is now, well, it was briefly a resistance, but it reclaimed it, bounced off again. Now we have this even lower resistance, broke through again, kind of disrespected it. After we rejected off of that level, we came back down to that previous support, bounced around a bit. But this is a bit messy. I'm going to cover this in the chop or like the zones video, but for the sake of this, right, we're just talking about peaks and valleys, right? Notable areas where we bounced off of. I personally don't like to mark up 1,000 different lines, especially on the 1 minute, but like I said, the concept is still the same. Maybe I should have started on the 1 hour for this example. That's my fault. But thought process is still all the same. So now we are in the 1 hour chart. Now, obviously, there are way less candles per day because there are far fewer hours in a day in a trading day compared to minutes. So that's why. But same exact thing that I did on the 1 minute chart. Bust out the horizontal line, mark up any notable peaks and valleys, any spot where you can tell like price pushed up into and then it failed, it started to stall out and then it started to reverse. Or mark that up as well. Also, a key note that I want to make. I personally like to, when I'm marking out my levels, whether it's support or resistance, doesn't matter. I'm always going to mark up the wicks. So the wicks are the tops of these skinny lines, right? Not the candle bodies. I always mark up the tops and bottom of the wicks. Some people like to mark up the candle bodies, but just personal preference. I've had better success with marking out the wicks. I feel like it gives me a better understanding of the previous price action. So that's what I do personally. But once I'm done marking these up on the 1 hour, then I'll break it down to the 15 minute. And now in most cases, these levels will overlap. As you can see, I only marked up spots on the 1 hour chart, but you can see right like here, perfect. Down here, of course, perfect. Spot on. Of course, you know, they're not going to always line up 100% of the time. There are going to be different lines that you have to mark up to get a better feel for. This is how we were acting on the 15-minute chart. This is how we were acting on the 1 hour chart, 1 minute chart, 5 minute chart, etc. But in general, I always pay more attention to the higher time frame levels. I don't really mark up too many levels on the 1 minute or the 5 minute chart. I really just use the 15-minute and the hourly, just because as you saw in that couple examples ago, I was marking up levels on the 1 minute, but it just gets very messy very quickly. So I pay attention to these higher time frames anyways, so I'm not going to spend very much, if any, time marking up all the levels on the 1 minute. So yeah, that was just to show the concept of marking up peaks and valleys. Okay. Yeah, so like I said, in terms of actually marking these levels out and getting an understanding of how to look for them and how to spot them, and then how to utilize them and like what to look for when prices in that spot, pretty straightforward. But you just need to get the reps in, open up a chart. Doesn't matter what it is. You can do it on Apple, NVIDIA, Google. It does not matter which chart you're looking at. You can do this on any single chart, any single asset, and the concept is still the same. Higher time frame levels are always going to have much more weight compared to a lower time frame level, just because, right, they have much more data in them. A lot more volume was going through them to create that level. So keep that in mind when you're marking them up, as well as when you're trading them. So I hope that helps. Give this a shot. Like I said, you can do this on any single asset that is on a chart. BTC, Ethereum, Google, NVIDIA, Netflix, whatever, NQ, ES, it does not matter. This holds true for every single asset on there that is a tradable asset that is on a chart. So try it out. Just like with everything else in this series, right? You need to actually implement the information and apply it to your own learning and your own education. So watch these and actually apply it, practice on your own, and then that's how you'll actually make notable progress in your journey. So I hope that helps. I hope that's easy to understand, hopefully, but if not, let me know. And yeah, appreciate it. I'll see you on the next one.